Okay, folks, we get cracking there. So, as per usual, jump in. Any questions you have, stop, jump in. That's what this is supposed to be for. It's more about your Q&A than me talking consistently for the next hour. So the more you learn and the more everybody else benefits who view the recording later on. So please, any questions you have, jump in at any stage. Suppose I want to kick off by I had a conversation with Roy earlier on, and I thought it was something there. It was a brilliant question Roy had asked, and I'd forgotten to actually clarify how good for people based in the UK and Ireland, selling the put options are in the tax-free environment. I forgot to mention actually the return on investment, believe it or not. So again, this is just a small kind of 10K account here. And we're just focusing in on this high probability option trade here on SPY. And you can see it, we sold, the $6,200 put. So again, I'm just going to keep reminding people the slight differential between doing it in a spread betting account and doing it through, let's say, Interactive Brokers or another options trading account. So there's no assignment of stock in this. This is literally a bet. Having said that, probability and everything else that goes with it is exactly the same. Okay, so what we're betting on here is that the S&P 500 stays above 6,200 by December the 19th. The size of the bet we put on was 10 per point, and the amount of points we did when we opened was 25.89. So in other words, we can make a maximum profit here of $258 or euro and 90 cents if SPY or the S&P 500 stays above 6,200. Now it's currently at 6,800. So it would have to drop 10% from here. So the probability of profit in this trade right now is 99%, right? But when we put that on, it wasn't. I mean, actually the timing of us putting it on wasn't great because we had the bit of a sell-off after it and it was in a loss, if you might remember. But if you look at our profit here, we're at $163 on it now at this moment. And I just wanted to kind of clarify the return on investment. Think about that. In 1 month, we could potentially make €258 profit on this trade on a 10K account. That's 2.58% tax-free with a 90% chance plus of making that return. So I'm just trying to highlight the benefit of doing the short put strategy for the people in the UK and Ireland in a tax-free environment. It's fairly powerful. It's not foolproof, guys. There's no foolproof investment. The nature of the word, think of it investment. There's no guarantee, but by God, your odds are pretty good. And again, just to reiterate why the odds are good, let me go to the S&P 500. There it is at 6,800 at the moment. Again, just to really, we basically put a bet on that said, as long as the S&P 500 stays above that level, we make our profit. So it can fall all the way from here, all the way down there, and we still make our profit. That number there is about 10% at this moment in time. That's why the probability is so high. When you actually buy a share or you do any trade and you need it to go up, your odds every day are 50% of making a profit. That's it. So it can go up, in our case, go sideways or go down. And that's the reason why the probability is so high. So just wanted to reinforce that again. So, again, it's something I think that should form the major part of your trading strategy. And if you don't, I think you're missing out on income. And, again, going back to this trade, the margin I put down on that trade, I think was about 2,900. Here it is right here. So it wasn't even a third of the size of the account. So I pretty much could have done double the size of that trade and taken in twice as much and turned that into like a 5% return on investment in the month. And traded, didn't do any other trade. If you continue doing that tax-free for the year, think about that. That's a 60% return on investment, tax-free in your account, with a 90% chance of making that tax-free return. The odds are pretty good, I think you'll agree. So I just wanted to reinforce that. I thought it was a brilliant conversation I had with Ryan. Thanks to Roy for bringing that up earlier on. It's something I didn't realize I spelled out enough to people, So is there anyone that has questions or comments on that, or is unsure about how it all operates?
Hey Stephen, it's Roy here.
Hi, Roy.
It's just the downside of it. I know I was talking to you about, say, checking into that. So, but if it goes wrong, how
Yeah,
does it go wrong, and sort of what do you stand to sort of not gain or lose, so to speak?
yeah, brilliant, brilliant. Great question. So the way that works, Roy, is we've sold 10 per point on that, right? Let me go back into the position. So let's say, for argument's sake, bad news comes out, the S&P 500 does drop over 10% in the next month and hit 6,000, for example. Your loss in this trade is 10 times the differential between where it's at. So let's use 6,000 as an example. So 6,000 from 6,200 is 200 points, multiplied by 10 is $2,000. Multiplied then, this is the income we actually took in. We take this away, so it's 10 times that taken away. So our loss in that situation would be $1,750, okay? If it went down to 6,000, for example. Now, the statistical likelihood of that happening is 1%, okay? Having said that, it can happen, and you're absolutely correct in pointing that out. What we would do, though, and here's, it's a brilliant question again. Let's imagine now, right, that we're getting nervous and we wanted to manage this trade. Obviously, we wouldn't be getting nervous, but just pretend we are. And it's telling us right now to buy this out ourselves out of this contract. It was cost us 965. You can see that. So 10 times 965 is 96. So what we would actually do, Roy, as the market starts falling towards that level, my trigger is 6,300 for something like this. So if SPY got to 6,300, I would do the roll out and down.
Mm-hmm.
Okay. So what does that mean? Let me show you. I'm going to go into our options here. I'm going to go into the US SP 500 and I'm just going to look at monthly options on it. Okay. So, actually, we don't even have to use that example. Let's imagine now we had sold the 6750s for whatever price, and we're getting really, really anxious now. Okay. We could actually buy ourselves out of that for 65, you can see, right? That would close us out of that December contract and we walk away. Now, if we wanted to establish that and all we're trying to do is roll out and down and reduce our break-even price, what we could actually do then is go out to the January contract and look at where we would actually get 65 in. So let's go to January, and you can see we're scrolling down here, and all of a sudden, we've brought that break-even price down to around 65.75. So we've gone in December, just to remind you, from 67.50. Let's say we're rolling this one out and down. We go to January, we can actually bring that down to 65, in and around 6,500. So that's how we would actually manage that in reality. Now, I just want to stress again, I'm picking a really extreme example here, right? When we're setting up this trade, I just want to remind you our rules on this, right? To give us our statistical probability. And so if we were doing this today, right, I want to show you what we will be doing. We will be looking at 6,800. And I know just from the studies I've done that I want to be 5% out of the money. So I'm looking at a strike of in around, let's call it 6,400. Okay. So if I go into the platform here, let's go back to December, 6,400, because I know this is what gives me my 90% chance of winning, is in and around 5% out of the money. And for put options, that means your strike price being below the current share price by 5%. Okay. So we put this trade on. Let's say we had this trade on now, but for whatever reason, you know what, we want to look at our risk management plan in advance. I'll know now, I can go into January right now and figure out where I could roll this out and down to if things started to go wrong on me here. So I'm going to go into January and see where I'm getting 17 in. And I can see here, I'm rolling that down to about 6,000. Does that make sense?
Yep.
So again, it's a little bit like rolling out and down in your traditional sense. It's exactly the same scenario. You're literally buying back one contract to open up another to reduce your break-even price all the way down. So when your starting point is here, our starting point is 6,800. We're going 5% out of the money for December, let's say. Things go wrong, and we're going, right, if things go wrong, how far can I roll it out to? And you're seeing it's down to 6,000. And that's not going to be any additional cost to you. You'll still have the initial credit we spoke about, okay? So then that's a fall of 800 points on SPY. So a fall of 800 points on SPY is, from where it is right now, is the equivalent of an 11.76% drop. So the statistical probability of that happening, again, will be less than 10%. So even though we've gone out to a longer time frame, and this is exactly how you would manage that trade, like you would manage a traditional short put option trade.
Would you use the same strike and the IG system as interactive brokers to do that?
Yeah, I would, Michael. Yeah, absolutely. If you stick to the rule, okay, 5% out of the money. If you stick to that rule, you will be managing it at times, but I'm telling you now, you'll be managing it maybe 1 in every 10 trades. So there will be a management at times where, look, things go wrong. So for example, if I go to the chart, let me try and get an example. It's very hard to find one until we go back to the mayhem back here. But even look at the mayhem back here. Let's imagine, right? Let's imagine here, what's that? The 20th of February, right? So a month from the 20th of February is the 26th of March, right? So let's say we did this here, right? Now, that was a really bad event, wasn't it? So just to remind you, this is Trump tariff war, the start of the Trump tariff war, and he's going bananas, right? So this, let's say we got our timing all arseways on this one, right? Let's go down 5% from here. So there's 5% from here, right? So we know now that we would have rolled this out and down, and we know from just the previous experience by potentially another 5% into the following months, okay? So let's say we're rolling that down. We've extended the time frame. We're right down there now to 10%. It was actually 12%, wasn't it, in that one? Sorry, 11.5. So this is exactly where we're going to be now. We would have had our break even down to this point here, okay? Okay, SPY, this was a really extreme event. You know, SPY did drop to 5,000. So you're talking about a worst case scenario event. Don't forget, in the space of about 2 or 3 months, SPY dropped nearly 25%. And we would have been just managing a trade that was pretty much 5% out. It would have been a much easier manage, if that makes sense. So that's an example of where, look, it really went pear-shaped and we would have been doing a bit of management. But more often than not, your pullbacks are something like this. You know, they're very inconspicuous. Again, if we go up here and look at, well, let's say we got our timing really wrong here. You know, that's a 5.5% drop. Don't forget your credit would have had your break even below that as well. And you would have rolled out and down to somewhere like here. Do you know what I mean? So like, again, it's we're just talking, I'm just trying to go back and see, would have, in the last, let's say 5 years, when would we have actually been cut out? Here's another one that looks like it's a significant one. There's a 20% drop. Again, we would have in this scenario rolled out and down, and we would have been within touching distance of getting to that break-even point, if that makes sense. Now we're assuming this is at expiry of the second one as well, and we're picking an absolute worst case scenario here, if that makes sense.
Yeah. Say the SPY is trading at 680 today, or 681, or it's closed, of course. In IG, would you be using 660 or 640 if you were hypothetically doing a trade on that today?
If I was doing that on SPY today, I would.
Yeah.
It's 6,400 exactly.
60, yeah.
Same. So if you look at SPY here, it's actually tracking the futures price. So we just go into indices here, look at SP500, it's 6814.
Yeah.
Okay, so we go in here, it's 6812. So it's pretty much matching it straight off, you know?
Yeah.
So you would use the exact same ones, yeah, absolutely.
Yeah. Yeah.
Is that okay, Michael?
Oh yeah, it is. I know you won't be placing the trade like today or maybe on Monday or whatever. Just as an example, that's what I was using for.
Yeah, absolutely. So the next piece of the puzzle here is trying to get your timing right, okay? And you're much better off, again, if I just go to a chart and bring in the VIX. So, you know, you have IV rank, you have all of this stuff in your Interactive Brokers account, right? But let's say you switch to IG index and you're going to do everything in there. You won't have the same tools available to you. But the best time to do these strategies is when the VIX is high. So again, just for people who are new to all of this, the volatility index, which is the VIX, it's a measure of, they call it the fear index. And it's basically measuring the implied volatility in the S&P 500 options market, okay? And when the implied volatility spikes, the VIX spikes with it. So that indicates when fear is at its most. So just remember what you're ultimately doing with selling a put option is selling insurance. And insurance is more expensive when there's more volatility. It's as simple as that. So when you're selling that insurance, you're getting paid more. So normally when you see this with the VIX, you're seeing the S&P 500 come down. So my point to you is, when everybody is terrified, folks, and you're seeing the VIX spike, and you're seeing this type of thing happening in the S&P 500, you're going to get paid more. And in fact, you could go further out of the money than 5%. You might even go 8% out of the money, just to give yourself more wiggle room. You're going to get paid big, juicy premiums because those insurance premiums have shot up in value. Okay? It's just the way options are priced. Does that make sense?
Yes.
Yeah.
Sorry, Stephen, can you go back to the chart of the VIX there, please?
Yeah.
Now, as a rule of thumb, do you see where RSI is down there?
Yeah.
Now, I've just glanced at this as you're showing it there. I'd say rule of thumb, would you say sell in and around when RSI is 60?
Yeah, like
Or a pre-treatment?
absolutely. Once RSI is see these events where it's getting to 70, they're your absolute triggers. Start selling put option premium. Absolutely. Because when this is happening, the stock market is going up. So again, if I just, that date there is the 17th of October, for example. So let me look at SPY on the 17th of October. Is here. So there's the 17th. Look what happened to VIX. We know the VIX went down after this point. Look what happened to the stock market. It went up. So you could literally map it over each other and you'll see a total inverse correlation. So absolutely, Roy, you could use RSI and the VIX as a measure here too. And you could go, yeah, like if RSI starts getting above 60, it's a great time to be selling put option premium.
Yeah.
So the point I'm making is, though, guys, that we have to be honest about this as well. If you look at the trend of the S&P throughout the year, there wasn't very many of those events where there was big sell-offs, right? So you're going to be selling put option premium along the way. And sometimes you're going to not be getting juicy premium. You're still doing this strategy as such, generating your income. And you're going to be on the wrong side of it, managing it, because implied volatility picks up. But you know now how to do it. It's to roll out and down. And the key is timing in that. Don't try and let the trade worsen. So, for example, if we did this trade today, and as I said, 5% out of the money, let's say is 6,400 here, I'm not waiting on this to happen before I start taking action. If it gets down to 6,500, you just get into a routine of being absolutely methodical on this, roll this one out and down. Out you go. You know, so you buy yourself back out of this one, you go out to the next month out, and you're selling. We already established we're selling down here. Okay. So you don't wait, because the reason for that is when it gets down below the strike price, it gets a lot more difficult to roll it out and down to a lower strike. It's just the way because the option has gone in the money, the time value is starting to decrease, and therefore you can't sell as much time into January.
Yeah.
So it doesn't work out as well because there's more value starting to build up in this option the further it goes in the money. So you really want to take action on this before it gets below your strike price.
Instead of going out 4 weeks, you're nearly having to go out 6 or 8 to get it to the.
Correct.
Yeah.
Correct. Yeah. So that it's much better take action beforehand, and it will happen. So, but once you have the knowledge on how to manage it, it's not something to fear, you know. And then at the end of the day as well, guys, remember what you're ultimately suggesting here. You're getting involved in the S&P 500. Now, if it sells off 10 or 15%, and I want to go back to the VIX again, just very quickly, usually it's followed by a snapback rally. So look at these spikes in volatility. Imagine what the fear was like back here, for example. And I'm going to go back to, what date was that? That was the 7th of April. Let's go to the chart of the SPY on the 7th of April. There we go. Look at the snapback rally in the S&P 500. It's usually followed by that. So even if you're under pressure on a trade, you've rolled it out and down. But when you start to see extremes on the VIX and the RSI in the VIX over 70, you know that a snapback rally is not too far around the corner. Okay, so just remember that as well. Is that okay?
Yeah. Well, looking at the SPY since last March, April, nearly everything that we done on it has been profitable, and very few of them have had to be managed.
Yeah, we managed one, I think, in the last year, and we've been profitable in everything.
Yeah.
We haven't lost in any single short put or ratio put spread. Not one.
No, that's true. Yeah.
Yeah, and we right there. Granted, there was one or two we had to manage for a while during this period. I think it was. But other than that, it was.
It's Stephen Gavin here. Sorry, can I just quickly ask you? Can you hear me all right?
Yeah, go ahead.
Yeah. Imagine watching the backside fall out of this, and you're getting yourself. You know, you're obviously not prepared to take assignment. There may be a time where I wouldn't mind taking assignments.
Yes.
You know, looking at it like you said with the VIX. You know, when it spikes, eventually there's got to be a snapback. What about rolling out and down to a point where you're content to take assignment rather than just trying to keep it ahead of it, kick the can down the road? Is that? I mean, because I'm thinking if I do it, say if I had a trade on right now, here we are going into December, and I didn't like the look of it. I'm going to roll out till January, and then I didn't like the look of that, and then into February, and wait a minute, when am I going to start getting paid? Something has to come of this, and presumably there comes a point. Well, not for everybody. Somebody might want to take assignment. I might at a low enough price in anticipation of that snapback. Is there any other way of being able to profit in the meantime while I'm holding my breath for the next month or the month thereafter? Or is it a case of literally just taking it month by month? Okay, I'm not going to win this month, and I have to see what I can do the following month. Do you get what I'm saying? Is there any other way to be able to?
The only thing I'll stop you is that you are generating lots of income every time. So you are. So sometimes it looks like when you're doing the short put strategy, you might think, I've a load of cash in my accounts. I'm not doing any trades, or let's say I'm not long on anything. But you actually are. You just haven't, the cash hasn't been put to work because you haven't been assigned, but you've generated the income. Now,
okay.
But it may be an answer to your question. The second part is, let's say you sold puts here, but you feel the market is going to go on up. What you could do there, right, is go into and actually buy call options. So let's say, for example, you felt, actually, do you know what? I'm going to use my put option income to buy my call options. So for example, let's go out to December the 19th here, for example. And I can't remember, we took in $580 so on one trade recently. I'll talk about the ratio put spread in a second. But let's say you could say, right, actually, I think now, do you know what? There's no risk of this going down, and I actually think the market's going to go on up. Well, then you can start looking at selling or actually buying call options.
Buying the calls, okay.
And that's the way to benefit going back up again. And then if you wanted to limit your cost in that, you could just buy a bull call spread instead, or which would mean that you're basically selling a cover call on your long call, which will reduce the cost of it a bit. Now, the only downside of that is you're capping your upside potential. So I used to do what I call Super Bowl strategies, and I missed it this year. I can remember doing the webinars here, and I can remember saying, guys, like, I remember distinctly saying, when this happens with the VIX, it's usually time to buy. But my fear was the rules of trade were being literally ripped up, and we didn't know where it was going to go. In hindsight, we should have done it. But normally what you would do, something like here, is sell your puts. Remember the premiums you're generating, and then you buy calls with that long-term leaps, and you benefit from this rally all the way back up. So that's another strategy you can apply, Stephen, where you buy the options, or just buy the, So
just you say again, just buy what side? Just buy outright,
or else buy the stock outside. No. So that's the other way. But this is statistically what I'm getting at here. This is like your statistical income that you're going to generate every month. So I've shown you an IBKR that you can generate 2 to 5% a month on this, with a 90% probability of making it happen. I'm saying 10% of the time you're going to be in management mode, but 90% of the time you're just going to be collecting income. It's a fairly stress-free strategy. Whereas with the best will in the world, let's say if all of us sat around the table today and said, right, what do we think the S&P 500 is going to do? I guarantee you half of us will say it'll go up, and half of us will say, do you know what, it's very overpriced at the moment, I don't know. So half of us is going to be right, and half of us is going to be wrong. That's why it's a 50-50 bet. And whereas this one statistically is you're making your 2 to 5% a month with a 90% probability. I much prefer that type of trading. Having said that, recently when this happened, we've the ratio put spread on. So remember the ratio put spread we had on, and I was saying we owned one put at 6,600, and we sold twice as many at 6,500. And I was saying I want to take off the long put because I felt the market was going to rebound. And again, I left it too long. I should have pulled the trigger. And the reason I didn't pull the trigger, by the way, is because of Bitcoin. When Bitcoin got to this level and breached all these supports, I felt, you know what, we're coming down to 77,000, and the S&P was coming down with Bitcoin. Now, that might still happen. We'll see. It looks like Bitcoin has stabilized quite a bit. But my view was, you know what, we probably will see another 10% drop in Bitcoin, maybe 20, and that's going to bring the S&P with it. And that's the reason why I didn't take off the long put on that trade, to try and maximize my income. So what I would have been left with there, Stephen, is actually I've absolutely nailed the long put. If I'd have done it at the time, I think I could have sold that for nearly $19 or $1,900 contract. And I would have been left with just 2 naked 650 puts. Now that would have been higher risk. Okay. My wiggle room for it going wrong is less, but it's still a high probability trade. In hindsight, I would have won big on it. No, I'm still winning on the trade. We're still up $400 a contract. I'd be up probably about $2,500 a contract if I'd have done that. No.
Another one on that, Stephen, like when that ratio put spread got down to around the low 650s.
Here,
yeah. Maybe because we had a nice credit ticket in on that trade, maybe that was the time like to go on the long call.
Correct. You could have looked at that now. Having said that, Michael, I'm giving you all the negatives here. If I can go into an option quote here, right? If you look at the implied volatility here, right? You can see the implied volatility is quite low now.
Yeah.
That was over 20% when that event was happening. That means these prices here reduced.
Inflated, yeah.
So you're paying more for your long call as well. Okay. Yeah. And that's the risk. When the event is happening and things are falling, the price of options get really, really expensive. And a great example of that is in individual equities, actually. So when when a stock is coming into an earnings report, the implied volatility as we get to the earnings reports gets really juiced up. Okay. And sometimes people buy call options going into earnings. The stock jumps and they still lose on their call option. And they're going, how can I be losing if the stock market went up, if the price of the stock went up? And the answer is the minute earnings are released, the implied volatility gets crushed in the option because the information is known. Everybody knows whether it was good or bad earnings. Therefore, there's very little uncertainty anymore. And regardless, the implied volatility part of the option actually gets crushed. And the value of the option can go down even when it goes in your direction. So you don't want to be overpaying for the option is what I'm trying to say to you, if that makes sense. Okay.
The only reason that I mentioned that one is the fact that we had taken in something like close enough to $6 and that ratio put spread as a credit.
Yeah, we did great. I'm just looking at it. I'll go back here and look at it.
Yeah.
It's a brilliant trade. I love that trade as well because we took in $580. We're up 414. As I said, hindsight's a beautiful thing. If we close down this part here, we'd be up another $1,800 on it now.
Yeah.
But it'd be 13 because it's worth what, 4 now, is it? Be 13 or $1,400. But anyway, that's all well and good saying that now, but you have to really put yourself in the mindset of, well, what if this did happen? How would I have felt about those short puts then? And that's what I really wanted. I was expecting this next. I was expecting this level to be tested, and then I was going to pull the trigger and take off my 660s. They would have been so far in the money, because then I would have felt we were due a rebound. Our VIX would have got to really elevated levels, and bar Bitcoin having a bit of a wobble, there wasn't really anything going wrong in the market. Earnings have been incredible. The AI trade is still alive and well and still going very, very strong. So for me, it was just presenting an opportunity to buy. Waited too long in hindsight, but still making money. So I won't be too hard on myself.
But not every account is able to take the assignment of the SPY either.
Well, that's it as well, Michael. Everybody's different. And I keep saying so if you're going to trade, I'm going to talk about the two different accounts now, right? If you're going to trade an IBKR, make sure your margin amount. So here we go. Here's the maintenance margin here. I've got a short put, I have a ratio put spread on, and I have a couple of bull puts and bear spread I was demonstrating here, okay? Again, high probability trades here, guys. High probability trades, look, they're winning, okay? But anyway, this is a 35K account, right? So the margin on this is 18. It's about half the size of the account. Why is that important? Because your broker deposits margin to help you maintain these positions, right? Now, if some of these trades start going against us, that margin starts going up. So you could be at a situation where the margin gets to 25K. Now, if we start out now at 30K, for example, and SPY starts dropping, all of a sudden we're getting a margin call here. They're going, you're getting a little bit tight here, guys. You need to sell off something. And we don't want that. So that's why I'm saying to people, never have your account, if you're going to trade the options as a return-based strategy in IBKR, at 70% of the value of the account. So don't do that. So for example, I would say the maintenance margin, once it gets to about 25 here, that's it. You know, you don't let it get above that level. And that's to give yourself a buffer zone to stay in these trades for as long as you can. So I hope that makes sense.
Yes.
And then if we go to the IG platform, it's slightly different. This is not, it does increase, by the way, as the trade starts to move against you, but not because of the trade we have on, the high probability nature. It won't move by as much. And I say to people here, don't let that get, let's say, to 50%, or maybe stretch it to 60. So in other words, if the size of your account is 11, 8, or 12, don't let your margin get above 6 or 7 on that. Now, if you wanted to do a few short-term day trades that are getting closed down that day, that's fine. Bring your margin up. But for your core S&P 500 trade, maybe keep your margin to half the value of the account, if that makes sense. Okay.
Mm-hmm.
Alrighty, is that okay on that, guys?
Yeah.
Any questions there? I don't know. I think, did somebody put up their hand earlier to, somebody's typed in a comment. Okay, perfect. Okay, I want to move on to just on the day trading stuff, guys. Actually, before I do, just on MGM, a lot of us have it in our short-term trading account. It's jumped up nicely there. And we have I have a limit order in to sell at 35. I'm getting out of this at 35. And would you believe it? It got yesterday to 34.97. So I was expecting a nice Thanksgiving present there, but it never kind of got there. But I expect it will. Okay, so just on MGM, we're going to exit out of that at 35. Okay?
Just a quick one on that, just that I see it there. ALK, is the target still the same? I hadn't looked
Oh
at
yeah,
it.
this is not unusual for something like Alaska Airlines to have these type of wobbles. You can see here, like there's a wobble from 57 all the way down to 31. Okay, it took a couple of months to come back, but it recovered. I would fully expect this to be getting in, touching this high again at some stage,
I got it signed at 41.20.
Yeah, I'd leave that on.
Mm.
I'd leave that on and get out of 50. I think it's 55, 56. We've got the target on it. So I'd leave that, yeah. Okay, switching back then to this kind of day trading, spread betting platform. I just want to kind of go through the rules as such. And you're trying to build out rules. And I just want to remind you, guys, these trades are a 50% chance of winning, right? Even when you put your technicals and all in your favor. And just in my opinion, a lot of technicals are absolute rubbish. Like MACD and everything, I don't think they give you any statistical advantage. They're too slow. It's just my opinion, okay? And I argue the toss. I'm sure there's a load of technicians out there who totally disagree with me, and they're entitled to their opinion. But my opinion is most technical indicators are absolute rubbish, and they don't give you any statistical benefit. I just think RSI and stochastics are the best ones for me. And then when you apply your traditional support and resistance, we're just trying to put on, let's be honest about it, these are bets, daily bets that we're putting on, that are putting on as much in our favor as possible. And I have found statistically, when RSI gets into overbought or oversold conditions, that provides the framework to start putting the trade on, So I've harped on enough about making sure you're not trading around news and all that. So I'm not going to go back over that again. But other rules that you could use to refine when we go back into our 15-minute window. So let's say, for argument's sake, you might have noticed a couple of days ago I said, look, I think it was gold RSI got above 70 or one of the currencies, and then we didn't trade it. And that's because it kept making these higher highs going forward, and we said, right, stay away from it. There's obviously a trend breakout here. So what rules could you apply? And again, they're not going to be 100% foolproof, by the way. Well, one is you might wait for RSI to cross back down 70. So that could be one rule. Say, right, I'm not placing the trade till I see a clear directional trend and momentum here. And then you might say something like maybe 2 15-minute candles are negative in a row. And then maybe I place the trade. And even if we did that here, and this is the reason I'm pointing this example out, is it can sometimes start moving back up again. It's not going to stop you out, right? And that's another thing on stop losses on these. I think you need to have a smaller bet and have a wider stop loss to stay in the trade a little bit longer. But surely enough, it did start the trend of actually we're going to come back down again. Okay, so I think that if you actually look at traditional support and resistance is good. So let me go to gold as an example here. So I've got Bollinger Bands on this one as well. So if we're coming along here, you can see if I was to draw support and resistance lines there, it's very, very clear, in my opinion at least. Support is there roughly, and then if we drew a resistance line, we'll be up here. That's one. Sorry, my support didn't come down. So you might use that as well. You might go, okay, actually, you know what? We've come back to a support area here. it is support. Maybe we wait for a bullish candle. RSI's got below 30. Happy days. Wait for maybe some indecision to form here, and maybe this is your candle you start thinking about going in on. You know. So what I'm talking about is refine it back down for yourself. Everybody is different. So I think to make this easier for everybody, if you put the alert into your charts, whatever platform you're using on the 15-minute window, so I'll show you here very quickly. You can come in here. Let's put an alert on this one. We're going to change the resolution to 15 minutes. And let's say we're talking about the indicator we're looking at here is, let's say, RSI. And we're saying RSI 14 is, let's say, at 50, for example. And we click on add indicator. Okay. So that's what we're looking at here, is that the RSI, once it gets to 50, give me an alert. Now, we're only interested in 70 and 30. Okay. So that will ping to your phone. That piques your interest and go, oh, I better look at the chart on this. Then you refine your entry point. If you're lucky enough to have the time to look at this, what I would suggest is, everybody asks me this, why 10 points? 10 points is it's just my experience that something can move, let's say from a peak here to 50 is usually a little bit more than 10 points. So that's my key to get out is when RSI gets to 50. But let's say I can't watch the chart or I can't watch the trade all day. I want to program in 10 points because I know just from trading it quite often, it's about a 10 point, it's just over a 10 point move back to 50. And then I want to get out. I'm not waiting for a return back to 30 here, for example. I want to be in and out of these trades in a matter of hours, if not minutes, if that makes sense. Okay. So I hope I explained that okay. That once you're in, if you have time to sit here and watch it, great. Once RSI gets back to 50, close down your trade, walk away. And that's it. And don't be afraid to take the hits on them. And just remember again, I just want to stress, these are 50% bets. So don't let your bet get out of control. If you lose on the trade and it hits your stop, take the hit and walk away. You know, if you can get into that discipline, nobody wants to take a loss. The temptation is to leave it on. The psychological impact kicks in and you go, oh, I'll leave it on, I'll push out my stops. And the next thing you're managing a worse trade, you know. The gains will outweigh them over time, but you are going to have losers. Just accept it from the beginning. If you're not ready for that, don't do this. You know, go into stocks or something that are longer term and have time to recover. But this is short, very, very short term trading we're talking about here. Okay. Any questions on that?
Hey, Stephen Roy here. I just got an alert on the British pound dollar. But as you said, the news events aren't too good, so stay away from it.
Okay, what alert did you get, Roy? I haven't got it here in the chart at the minute.
Yeah, it's on the 15-minute. It went over 68.
Oh, 68.
On the
Okay.
order, yeah.
Yeah, so I'm not. This is a great example. So the first thing I'm going to switch back over here, Roy.
Mhm.
Now, it would be fair to say we were going sideways, and then we went into this lower lows, didn't we? And we broke that support.
Mhm.
Now look what's happened here. Where's my little marker? God, I can't find it. Anyway, I'll just point to it. Sorry, I can't find it. I'm going to zoom in on this one. We've broken out of this downtrend, haven't we? And we've gone back in to the lower end of this sideways range. Therefore, and we're creating higher highs on this, aren't we?
Yeah.
I would be reluctant to place that trade.
Yeah.
Okay, for that reason, the daily chart is telling me we might be making a longer term move back up here.
Yeah.
And so I would be reluctant to do it, to be honest. I think we're fighting against a potential new trend emerging here.
Yeah. So not only the news events, but the daily chart as well.
It's very important.
Yeah,
don't ever fight this chart.
Yeah.
Don't fight that trend, you know. And this trend, that's a breakout. I think there's a possibility we come back here and test this here now, but we've created a new high today at some stage. Therefore, that upward pressure is still there right now. And the fact that this is getting approaching oversold on the 15-minute, if we short this, we're basically giving the two fingers to the daily chart, and we're saying you're wrong.
Yeah.
And we're going to come back down. And I'd prefer not to do that.
Yeah.
How do you set up the two side by side on the IG?
So,
Sure.
okay, no problem at all. So if you go into see all these icons at the top here, Michael?
Yeah.
There's one here that says split chart.
Okay.
I could turn that into 3 charts.
Okay. Got it. Yeah.
Okay.
Yeah.
And then I'm one of these people that has to have processes. My dailies have to be on the left and my 15 minutes have to be on the right. Just, if I'm just one of those, if it's not in that position, I get irritated. So there you go. So do it what's right for you. I just look at RSI and I look at support and resistance, really, on the short-term time frame. Everything else, in my opinion, is a waste of time. Bollinger Bands aren't too bad, because at least Bollinger Bands are giving you, it's like a probability trade. Where did I have the Bollingers and the gold? So what this is, again, just to remind you, the Bollinger Band here, that's a 20-period moving average. So that's calculating over the last 20, 15-minute candles what the average is, right? And then the upper channel and the outer channel are 2 standard deviations away from this. So statistically speaking, when that happens, you've less than a 5% chance of it actually getting there, and usually there's a reversion to the mean at some point. That's what they're banking on, okay? Sometimes you can get a situation like this where they walk the band, the upper band. So again, it's not foolproof, but eventually, look, we revert to the mean. The problem is here, for example, if you shorted it here, you would have got out break even using Bollinger Bands alone. But again, you would have to have further rules for you to actually make that trade. So for example, there's one on the downside. We hit the outer extremity. What is your rule for getting in on that? And for me, I'd want to see RSI down here at 30 as well, or RSI at 70. So I just use it in conjunction here, not on its own. I hope that makes sense. And again, just to remind you what RSI is. RSI takes the last 14 periods, so whether you're on a daily chart or a 15-minute chart, it's the last 14 days or the last 14 15-minute bars, and they're measuring the relationship between the gains in the bars versus the losses in the bars. And that's all it is. It's telling you where the momentum has been. And the momentum, let's say, obviously, if it's positive, gets you over 70. But the rule is, again, or the ideology of it is, we eventually revert to the mean after that initial surge is done. And to me, it's one of the most reliable indicators that I've ever used. But it's still not foolproof. It's still not. There's no guarantee. And as I said to people last night, how often have you been in traffic, somebody's indicating to go right and they turn left? Charts are no different. And it's true. It happens. If a piece of news comes out, you can throw your charts out the window. That's life. If, for example, I don't know, Donald Trump decides today he's going to do something to get himself in the news, surprise, surprise. You know what? He could have a massive impact on the US dollar. So things happen. So charts get disrupted. They're not the holy grail. Don't ever think that they are. And that's why I go back to the initial thing that I peaked off with, these high probability trades. These give you time. They give you high probability. They're giving you 2 to 5% return on investment per month, depending on if you use it in a spread betting account or not. And it's giving you time to maneuver if it starts going wrong on you. That's the biggie. Whereas when you go and place a day trade, you don't have that time. Okay? So that's why I'm so strong in emphasizing it should be a huge part of your portfolio. I'm not saying don't do this. I enjoy it myself. It's a bit of fun. And you just try and put as many rules in your favor as is possible. But you're not going to win as often as you win on the other type of trade. That's all I'd have to say. So keep your bets small is what I'm saying. Okay, guys, unless you have any further questions, that's all I wanted to share with you today. Nothing else?
Well, a guy that I knew at one stage in the UK, and he would have been in the racing industry.
Yeah.
One of his rules when he was having a bet, regardless of the price, he used to never change his bet.
All right.
He kept the bet the same, regardless whether say the horse price was 4-1 or 20-1.
Okay.
Yeah,
Well,
that was one of his golden rules.
yeah, well, there you are.
Yeah.
Everybody, sorry, is somebody else hopping in there?
Yeah, Stephen, Richard here. How are you? I was
Hi,
gonna
Richard.
quick question. Just can you give your thoughts on Coterra, just with what's happening with oil and so on? It's just one we haven't talked about for a little while.
Yeah,
I'm still hoping.
yeah, it's went ex-dividend there again. I like, natural gas prices are nice and high, so that's good for it. So Coterra Energy is, 50-50 in terms of revenue from oil and natural gas.
Yep.
So with oil prices, kind of, if we come down here, where's crude oil at the moment? 58. It's actually holding up well, Coterra, because of where crude oil is at. Yeah, I'd be inclined to sell out at 28 if we do get there. Any bounce back, the thing I think you've got to have in the back of your head, and fingers crossed, I've everything crossed that there's a ceasefire between Russia and the Ukraine, okay?
Yeah.
If that happens, I wonder what happens to the price of crude oil, because the market will have to start factoring in Russian oil coming back onto the market. It's already in the market, by the way. They're just selling it to China and India or whatever. But my point is, I'm sure that's going to form part of the agreement with the international community, I would imagine.
Yeah.
So that's the only negative in the back of my mind on Coterra, that what if crude oil goes below $50 a barrel? So I would be inclined to get out at 28 if it gets back up there, Richard, But one thing that is supporting it here is natural gas prices. So here's your natural gas prices. So I would stick with it myself. Like, you're getting paid a nice dividend with the stock as well,
Sure, yeah. I actually have based on your advice, I have a limit sell in order for 28.
Yeah, I think it's been pretty much trading sideways between there. Our target price is actually 31 on it.
Yeah, I remember that.
I wouldn't wait around for that, given the risks that I spoke about with oil,
Yeah. Yeah, that's great. Thanks.
No problem, Richard. Any other stocks there, guys? Oh, somebody asked me about Meta again, actually. Should they get in now? They didn't get in.
Yeah.
I like it. I think Meta is very cheap. So I think Meta is going to be revisiting $800. So I wouldn't have a problem buying Meta here, to be honest with you. Remember Google, when we bought Google, we were down, I don't know where we were. We were here somewhere. We bought 159 or something like that. I can't remember what it was, but I can remember just making the argument for it. Its valuation multiples and everything. We went through it all, and I just felt it was just being totally discounted. And then, of course, we had the benefit of knowing that Gemini was a lot better than what people thought it was. And they're really benefiting from that now. So, and look what happened. I think when the fears get alleviated from Meta about their capex spend in AI, and when they actually show us how they're going to optimize their revenue because of AI, and I'm sure it's coming, I think you're going to see that explode again, probably over $1,000. So, in answer to the question, I would buy Meta here. Yes, I would. No problem. And it's still in an uptrend, by the way. Even with the recent pullback, that's still an uptrend. It's a clear uptrend. It's just broken into a new channel of an uptrend, but it's still a clear uptrend.
I looked at a call at it there about the last couple of weeks, and I think it's around the 590 at the time. And I thought they were too expensive.
They are. They're because it's a $600 stock, you're going to spend a lot of money on the call.
Yeah.
It's as simple as that. So And then, you know, when you go in the money and you're going, you know, you're paying more again because you're buying a bit of real value. So they are expensive, Michael, absolutely. That's just down to the price of the stock, you know.
We decided against it and decided to stick with the SPY.
Yeah, well, I tell you, SPY, it's a brilliant trade to keep going at it and keep doing. So I wouldn't have any issues with that. Okay, folks, I'm going to leave it there. Have a great Thanksgiving if you're in the US listening to this, and for everybody else, enjoy your day, and you know where I am if you need me. Just
have a good weekend. Take care.
Okay,
Cheers, Stephen. Thanks, everyone.
Bye-bye.
Bye.
Bye-bye.
Thanks, Aidan.